After a pretty strong 2017, 2018, has started a bit more nervously. We continued into the new year with a series of stock market highs, which were a pretty rare phenomenon until fairly recently in the UK. And then people started to get a bit more worried. We've had any number of things that concern people. But Justin, why has confidence run out of steam slightly?
Isn't it fascinating? You almost sort of feel how it's changed, can't you? Because last year there was almost this complacency, everything was going up, it's brilliant, everyone could be a really clever investor. All you had to do was, nothing. It just went up. But you felt pretty good about it. But on that basis, no, that sort of complacency, and you look back historically, Matt and the team are actually doing some figures. If you looked at the level of volatility, the average is normally to have a 1% movement in a day, normally occurs about 50 times a year, so once a week. Last year it occurred 8 times. In the entire year, it was flat as a pancake. Well, it was rising, but it wasn't very volatile. You take this year, we've done an entire year's worth in under 3 months. So it's changed, the whole atmosphere has changed. And people are now beginning to feel, ooh, hang on, there are a whole series of things that you were just inferring there. Is it Trump, the pulling back of quantitative easing and central banks start changing their attitude, rising interest rates, tariff wars or tariff issues, and of course Brexit. So lots of things to worry about. So therefore people are now more nervous. But put that against what the global economy looks like. And the global economy is doing quite well, makes a rotten headline, but does very well indeed, despite what Hugh Edwards says.
Richard, I should have introduced you at the start of this part of the show. Richard Hunter of Interactive Investor and a regular guest on the Investing Show for the last 3 years that we've been doing it.
Is it really?
It is indeed. And on many occasions over about the sort of last year to 18 months of that, we kept talking about when was this correction going to arrive? When was this correction going to arrive? And as Justin said, it did arrive at the start of the year, but can we expect more of that in the year ahead, do you think?
I think we've had something of an answer to that just yesterday or the day before, when we had 2 FTSE 100 companies in the space of one day. We had Hammerson up 25% on the basis of an unwanted approach from a French company. At the same time, we had Micro Focus down 50% in one day, which is absolutely incredible given what it used to be like, and it kind of also goes to indicate and exacerbate the fact that quite apart from the algorithmic trading that's going on, markets, generally speaking, tend to overshoot in both directions. And of course, there are indeed a whole list of worries. I think as investors, we prefer it when there are a whole list of worries rather than this complacency. And I think we're in a particularly fascinating point at the moment, for example, again, with what's currently happening with Facebook. We knew governments have known for some time that the internet is kind of largely unregulated. No one knows who owns it, no one knows who should own it. It's easy to try and move things around different jurisdictions. But it's going to be interesting, and only history will show whether what's going on with Facebook at the moment and the client details, whether this becomes the thin end of the wedge in terms of regulation.
Yeah, suddenly the FANGs, the FANG tech stocks, are beginning now to be pulled. Is it the issue about whether what Facebook are doing and how much they're disclosing? Is it about where they're going to be paying tax? Because governments will catch up on them. Or even maybe the Americans taking antitrust law. Do you remember with things like the oil companies in the 20s, Standard Oil and this American steel companies? They were broken up by the American authorities because they were seen to be ubiquitous and running a monopoly. And Google's pretty close to that situation, and Amazon as well. So it'll be interesting to see how that goes. So they've all gone far too far. But you then have to look at the rest of the market, what's happening. I think you're quite right. Markets love climbing a wall of worry. Now, look at the companies themselves. Corporate America, corporate UK is generally doing really rather well at the moment. Those figures actually aren't too bad, but those storm clouds are still there.
They are, and waiting for a catalyst. And there was an example last week, for example, the US tracker QQQ, which is basically the technology tracker, saw record inflows that we hadn't seen since the leading up to the dot-com boom around the turn of the century. Not an indicator in itself, of course, but what that is showing is that, quite apart from the fact that although at the moment these US tech companies have been able to keep up with earnings, there's this buying pressure coming through, which is keeping those share prices elevated. In turn, that is keeping US sentiment elevated. And if the US tech shares should, for whatever reason, decide to take a bath, that could be, a fairly quick overkill.
Justin, when we look at the headlines, however many billions wipes off the FTSE, that kind of thing, FTSE down X%, or even the companies, that are priced for perfection, that suddenly don't quite deliver perfection and take a big tumble. As investors, can we pay too much attention to those short-term price moves? Should we be thinking quite a bit more long-term?
I think, yes, you could easily get yourself into a terrible tiz. One of the first things you could do is turn off Bloomberg, because actually minute by minute they'll be frightening you as to things going up and down, and you shouldn't be thinking short-term like that. Those figures of the compounding figures, the ones I always get up, this is Barclays Equity Gilt Study used to have them. Vaguely, if I can remember the numbers right, 100 quid in what would have been the FTSE 100, of course it didn't exist 70 years ago, would now be worth around about £9,000. 100 quid 70 years ago, if you'd reinvested the divvies, was about 180 to 190,000. I mean, huge difference. So therefore, markets going up and down are not quite irrelevant, but they're not very important compared with the compounding over time. It's time in the market, not timing the market.
That's why Einstein called it the eighth wonder of the world, of course, in terms of compound interest. But if we've used this chart once on the investing show, we've used it a few times, and that's basically a share price chart of the all share from the Second World War to the present day, and it's pretty much bottom left to top right. There's a few little nicks along the way as that line has been going up, and those little nicks have been things like the oil crisis in the mid-70s, the crash of 87, the dot-com bubble bursting around the turn of the century, and latterly the financial crisis of 2008. In the overall scheme of things, yes, they were painful moments, and please, on the basis of what Justin said about Bloomberg, this is a long-term horizon we should be talking about.
It's interesting when you look at this. The bond market's high, equity market high. Yes, you should be concerned, and you could use this to your advantage. We have seen this year, at last, some volatility. There's going to be some more volatility. Interest rates going up, it'll cause that sort of issue. Leave aside any of the political issues we've got around at the moment. Have some cash set aside so that when you do see some of the significant falls, you can be buying good quality assets at a discount. I know that sounds a bit flippant, but if you like the businesses for the longer term and you can buy them at 10%, 15% off, there's no reason why you shouldn't. So you can't necessarily time it, but every so often when you suddenly see that drop, that's when most private investors get frightened and don't do anything. You know what it's like. We tend to buy at the top and sell at the bottom. Reverse the process. Have the confidence to know that is a damn good company. And if I can get that at a discount, I'll go in and do it. So have some cash, and then those alternatives we were talking about before as well. The ability to have those because of what's happening in the bond market as well. This making sure this diversification is absolutely crucial.
Now, there's one interesting market actually quite close to home that people don't like at the moment, isn't there? Which is the UK. If we look at the Investment Association figures, which shows what people are doing with their retail fund money, they're pulling money out of UK funds. They're even pulling money out of UK equity income funds, which are hugely popular with British investors normally. And they're putting their money into bonds, which is the thing people are being warned about is expensive. Now, is there a bit of an opportunity going on with UK companies, not necessarily those FTSE 100 companies, the big guns that their prices all went up because the pound fell after Brexit vote and everything like that, but the whole of the UK market, is it looking quite good, and is that dividend yield looking quite attractive?
Well, the particular report you're referring to had 22 asset classes which it looked at, and the UK market, the whole market, not just the FTSE, came in 22nd. What that's suggesting is that international institutional investors would rather be invested in cash than in the UK equity market. Now that's crackers. You're absolutely right. There are a number of quality companies dotted around the UK in terms of quotation, but there are some real high quality companies within the FTSE 100. Yes, it may be some of the reason their quality is because they're outward facing. It's estimated that 70% of earnings in the UK come from overseas, but by the same token, it's one that always seems to come up in these discussions. It's someone like the Prudential, for example. They are already hooked into the Chinese market where there's a burgeoning middle class who are very quickly realising that they need to be saving. They're already hooked into, via Jackson, the US baby boomers, ditto, and they're already hooked in, of course, via M&G and their own name to the UK consumer, who is also, as you were talking about in the first half, very well aware of his or her own requirements for long-term savings.
So you look at UK companies which are in the UK, operating in the UK, not having much outside. And there was an index that actually Bloomberg had last year, which was the FTSE Local. And that was purely domestic ones, and that went nowhere. It really was flat as a pancake. And what that was illustrating was not that they were bad businesses, there's just people were not investing in those. Why? It's the B word, it's Brexit. The international investors were looking at this and saying, until you can tell me what you're going to be doing, how you're going to be operating, we'll give a bypass to the UK at the moment. We like the international businesses because we can measure those, we know how they're going to be developing around the world. The UK domestic stuff will hold off. And this is also affecting investment into the UK businesses themselves, not just the share market. So that's something, the sooner we get clarity, whether you like Brexit or not, the sooner you get clarity, the better it's going to be.
Now, the other thing that has people around the world worried, not just Brexit, is the threat of rising interest rates. Now, we went through a period of time when actually we weren't that worried about rising interest rates. We had a period when we were very worried about rising interest rates, and we were quite relaxed with it. Now we seem to have gone back to a time, rising interest rates, because we think they're going to go up that bit quicker. But do they have to be bad news for investors?
Well, number one, they don't. There are a number of companies which can and will benefit from higher inflation and or higher interest rates. But again, it's a question of perspective. In the US, what the Fed is going to do, and I think they did hike a quarter earlier on, it is very much still with interest rate at historical lows. So what are we at? Half in the UK, 0.5%. If you go back to the formation of the Bank of England in 1694, the average interest rate since then has been 4.5%. So we are still at incredibly low interest rates, and no developed economy, be that the US or the UK, is going to hike rates at such a pace as to derail any economic recovery.
He doesn't look that old, does he? 1694 is doing quite well. But the point is with this, I think it's fascinating. These interest rates are coming up. First of all, one of the primary beneficiaries are banks. At the moment, we all know what banks are paying in terms of interest rates. Square root of sod all. Mainly because they actually don't want our money. As soon as you actually start seeing rates coming up a little bit, then it's of interest. They will start making money out of that. So even a 0.25% rise will start having that impact. And you'll certainly see that with the American banks. The other issue, of course, remember there are more savers and borrowers in this country, so any little element of interest rate rise starts to help those savers who are in a niggardly position at the moment, still in negative interest rates or interest rates lower than the rate of inflation. So anything can go up will certainly help there. But equities don't necessarily dislike rising interest rates, as long as they can try and manage it. What will be interesting is how it will affect some of those zombie companies, those companies that have been kept going by banks with low interest rates, because they didn't want to pull them, they don't want the bad reputation. As those rates start to rise, the cost for those companies with a lot of debt, not going anywhere, that's when it's likely to get pulled. So be careful of those, the highly indebted ones.
So check the balance sheet carefully, Richard.
Well, absolutely, especially the bank's balance sheets as well, of course, because whilst that's generally speaking accepted to be good news for banks as interest rate rises, by the same token you can see some of those impairments, bad loans starting to come along as well, but in overall terms should be good for the banks.
Yeah, some of those banks, RBS has still got huge issues to try and sort out in the States. Barclays has got a couple of legal issues to try and sort out over here, the issue over Qatar as well. So that's by no means sorted out. And it'll be interesting to see actually what happens with Barclays, because frankly as a business I can't see that staying together. I think that's one business that eventually gets split up. They're denying it thrice, so it's more likely to get split up.
Now I'm going to come on to some questions from the audience in a second if people would like to ask, but first of all I would like to ask you both, what are the bright spots that you see for investors? Justin first.
Okay, I still like investing internationally, so where would we look around the world? And I think if you're willing to take a slightly longer term view, not just developing markets and emerging markets, they've actually done really rather well. There are now methods of actually getting into frontier markets, which is the next area down, to which everyone goes, oh hell, at least it'll be riskier. But actually look at who some of these markets are. Things like Vietnam, those sort of countries where they've actually got some significant change going on, and you can see how that economy is changing. You can get an ETF just on Vietnam, or you can go to a frontier market fund, which will have everything from Kuwait. It may have Nigeria in there, and it'll have the likes of Vietnam and others. So you can actually measure, quite interesting, some ones in there. And so those are still going to be growing. And they haven't had as much attraction as the emerging market funds. So if you're willing to take that sort of risk, and I said of all those altogether, something like Vietnam, I think, is still a growing economy, which is still got some great value.
At the moment, we're in a situation where we've had a sort of synchronised global economic recovery. We're in a pretty good place at this moment in time. I heard someone earlier from the States talking about the fact that obviously a recession will come, but based on current indicators, the earliest they can see that coming in terms of the real economy is probably late 2019, early 2020. With the stock market trying to double guess that probably gives us at least until 2019, until we have to really start thinking about it, unless anything drastic changes. But again, even going back to the UK, an unloved part of the global market at the moment, the average dividend yield on the FTSE 100 is 3.5%, and that's before you even start. That's taking the whole lot as an average. And again, as you were saying in the first half, you start compounding 3.5% over 10, 15, 20 years, let alone any capital growth you might get in the meantime, and you're starting to get a fairly significant return.
And beating inflation.
Very much beating inflation, and again, getting rid of one of those old fallacies that the safest place for your 100 quid is underneath your mattress, because inflation will take care of that pretty damn quick.
Or the government, if it's in 1 and 2p's.
Yeah.
Right, does anybody have any questions? Oh, gentleman over there.
Mark Carney.
I'm surprised that your fixation on the interest rates today. Originally they're going up, but they're not going up to 15%. Most people in this room will remember interest rates were 15% in 1980, and it was horrendous, absolutely Armageddon. Interest rates in this cycle will go max 1.5%, 2%. Come on, get a life.
You're quite right, it's a different world. With 15% and we had 25% inflation, it was a totally different environment. Mind you, these lower rates have different effects, going from virtually 0 up to 1.5%, 2%. But that's going to be enough for certain companies to actually have some pressure on the level of debt that they've got. No, the impact this will have will be just certainly you'll see in the States, those rate rises going up will start then impacting on that bond market, and that's the one that really does concern me more. So if that goes up, and that will then start at some stage pulling money away from the equity market back into the bond market. But I'm suspecting we're going to be seeing 4 more rate rises, and so the effect doesn't come through in the States until you probably had 3 or 4, maybe more rate rises, and then you get to that sort of level when you could start seeing that switch over, but not yet.
And there's no evidence of it as yet. But I think the other elephant in the room is that in Germany, for example, into war, when they had absolute runaway inflation, rather like they've got in Zimbabwe at the moment, the Germans have almost to a man and woman had this real fear of anything like easy monetary policy, but in particular quantitative easing. And we've just had the biggest quantitative easing experiment that's ever been known. I don't think you even find it in the traditional economic books. And as we unwind it, the big fear, of course, if that was to come into inflation on a big scale, more than anyone had anticipated, what will normally happen first when you get runaway inflation is that central banks will start to try to combat that with aggressively higher interest rates. Now, we're not there at the moment, I totally agree, and I hope we don't get there, but we are starting to unwind QE yet, and there will certainly be some bumps along the way.
I think there is another thing that what happened to the economy after the Brexit vote showed, is that basically we probably could have raised interest rates quite a long time before we actually ended up cutting them, before we ever raised them. That 0.5% that was put forward as emergency measures in 2009, 2010. Maybe we needed it for a number of years, but I think there came a point where we could have got interest rates off the floor, and certainly for our readers at This Is Money, they would have been delighted to see interest rates rise. They have lots of people telling them how bad rising interest rates will be, and they're sitting there going, raise them, raise them, raise them, raise them. And I think that the resilience that the UK economy showed post-Brexit indicated that we probably could have raised them a bit, and then we wouldn't have had to cut from 0.5% to 0.25%. But I do think the Bank of England, having now raised them back to 0.5%, might have a little bit of an appetite for continuing to keep going.
I think they will, because the UK economy is in actually quite good shape. The concern that there is over Brexit is actually about longer term investment. So you've got companies investing for the next 12 months, but they're not prepared to take a longer term investment than that until, again, we come back to this point of clarity, so they know exactly what the trade deal is actually going to look like, and then you can start committing money, both domestic money and inward investment.
And even though it sounds slightly strange, we know that a recession will come again as part of the natural economic cycle. And where we currently stand, both in terms of the US and the UK, there's not much in the pot in terms of easing interest rates to lessen the effects of any given recession. So we need to get to a certain sort of level in terms of the level of interest rates to give central banks something to play with when recession inevitably comes.
Or even something to do. Any more questions? Down here at the front, this gentleman here in the blue shirt.
I was just going to say, do you think as far as the high street is concerned, do you think high street shops are dead? Every day, a household name falls by the wayside. You were talking about getting value for money in decent companies. If I was going to buy a carpet, I'd go to Carpet Right. If I might go to Jamie Oliver's for pizza, and these companies are just House of Fraser, just pretty much bankrupt.
Yeah, I would go for a pizza in Salisbury. I think what's happening is, certainly when you look at a lot of those restaurants, it's a type of funding which can be good and bad in terms of venture capital and private equity. And a lot of those businesses have been highly geared by private equity. And private equity works on a 3-year cycle, then they pass it on to the next one and the next one. And so you end up with these businesses which are very cyclical, dependent on the amount of disposable income, with quite significant levels of debt, and when it does see a turn down, this is exactly the result of it. So those ones which have private equity, I think, have been suffering a great deal. The other element, of course, is the change of technology, and we've all known this for some time, haven't we, in terms of those people that are buying over click as opposed to bricks. The Bees Jones or John Lewis element where they combine the two, but even they feel the effect of it. The style of shopping has changed radically. You only have to look at most offices these days. I suspect most of our office mail now consists of things being ordered on ASOS being delivered than anything else. So it's a fundamental difference. Plus the fact we've had a consumer boom, we've had a consumer peak, and of course the government was really lucky, because remember at the start of the decade, one of the benefits they had was £45 billion being pumped into the economy, courtesy of PPI. But sums of money for people who really weren't expecting £3,000, £4,000, and suddenly being able to pump that through. That was one-off, and so that's not going to be repeated. So we're on the back end of this, so you're going to see the weaker end. So I think it's results.
Retailing is really difficult because we all know something about it to a lesser or greater extent through our own experiences. If you look at Marks and Spencer, for example, they've struggled for some considerable years now in terms of their general merchandising, their clothing lines, and the fact that if you're 45, 55, 65, you're happy to walk into an M&S. If you're 25, 35, you wouldn't be seen dead in an M&S unless you're cutting through it to go somewhere else. At the same time, their food offering, their food merchandise offering, has been going gangbusters. So that's a Marks and Sparks specific thing. You've then got ASOS, which has shown exponential growth, as seen on screen, online only. Next, up until recently, has been doing very well. It was pretty much the first retailer in the UK to have any sort of internet presence, but it's got the mix right over the year between having a physical presence, but also that next directory. So I think retailers tend to get lumped into this one big thing when to a certain extent, they tend to be company specific. There's no doubt that shopping habits have changed, but there's still some very good retailers out there.
I think you made a good point though about things like Carpetright as well. So I think, as Justin said, with the restaurants, it's a really eye-catching thing. But a lot of what's gone on there with the restaurants is effectively financial engineering. Those restaurants have expanded so quickly due to basically someone with a spreadsheet working some stuff out. Their margins aren't great, and if things take a slight downward slope, then it's right, ditch the restaurants. With some of the shops, they're just getting things wrong. But with places like Carpetright, you're right, there aren't very many places to buy a carpet. Also, this is similarly true of some of the DIY stores as well. There's not a huge amount of DIY stores out there, and the housing market isn't doing that badly. Transactions are below where they used to be historically, but they're not that far below, and first-time buyer numbers are actually pretty good. And the one thing about first-time buyers is they do go out and buy sofas, carpets, stuff from DIY shops. And I don't know what the answer is as to why these shops aren't doing very well, but it is quite interesting when you consider that the housing market's doing okay, that they are really suffering.
It really does surprise me when you look at Kingfisher and you see how B&Q's been doing, and then you've got B&Q and then you've got Screwfix alongside. Screwfix doing very well as a trade outlet, but B&Q not. You know, you would have thought, surely are not more people actually doing any home stuff? And actually when you ask around, no, they're not. Why? Because they've been getting cheap builders coming in to do it, and decorators. Everyone has the ubiquitous send in the pole to go and do it, and they do it very effectively, very cost efficiently. Mind you, I live in Hammersmith, that's easy.
Any more questions? Got time for one more?
Hi, just a quick one. Through, so you said about interest rates obviously affecting the market, but we're in a time now where Twitter and celebrities have a big effect. We've seen that with Snapchat having 7.5% wiped off from a tweet. What do you think the future is with markets? Do you think, 20 years ago, for example, most people probably didn't have a computer. Now Twitter is changing things. How do you think the future of finance will be?
I think you ask an important but wider question. On the one hand, as we briefly covered earlier, there's a question of how some of these massive internet companies are going to be regulated and treated anyway. But the other question, particularly as we've seen to our cost in recent times, not on a stock-specific level, but generally speaking, is and notwithstanding what the President is saying about this, the ability or inability to filter fake news. And I think there was a fairly, Simon will know this better than me, there was a fascinating survey done just a few months ago asking kids in school whether they would read this that they might have seen on Twitter or something coming from BBC News. And rather worryingly, they couldn't tell the two apart. And so the question I think you ask is a much wider societal question, which does without question have an impact on financial markets until you can cut through and see what the real news is. So, certainly on a company-specific basis in the UK, we have something really boring called the RNS, the Regulatory News Service. That's via the Stock Exchange. If you haven't seen it there, it's rumour.
Just look at the row over Jeremy Corbyn's hat at the weekend to see how quickly news can spread that isn't necessarily true. I think we had one more question at the back there, and then we're going to have to wrap up, I'm afraid. That gentleman back there.
Yeah, thank you. I get the impression that you would probably prefer equities over bonds going forward, and then maybe overseas equities being overweighted rather than neutral. So could you give a bit more explanation about which overseas equities and perhaps developed markets, not developed markets, but emerging markets you might be more interested in than the markets that you suggested, which was Vietnam, which is sort of subprime type of emerging market?
Yeah, that's frontier, that is higher risk. Okay, guys, you've got views on this too, so I'll just quickly give you a view. I agree, our view would be one of we don't really like government bonds. we're steering away of that because of what we talked about with interest rates and the risk you've got with that. You'll still have some in there, but very, very short dated ones indeed. So yes, equity market, because the returns you're getting there with the yield that we were already mentioning just there is giving you just that base one to start with. A view that actually overseas is going to be more beneficial because you're seeing some good growth in some of those economies. One of the more unfashionable ones will be somewhere like Japan, because for decades everyone's been saying, and now it's going to be Japan, nothing ever happens. Because people go back to the days when, how was it, 30 years ago when the Nikkei was at 40,000, or just a tad under, and it dropped down to 7,500. They're changing quite radically now in terms of corporate behaviour in Japan. So that's the one I think has got more interest. The US has already gone a long way, so I wouldn't be looking at certainly the major ones there. Take it lower down to some of the small caps in the Russell 5000. That I think will be more interesting. European ones, we've been favouring the past year, but a lot of that has already come through. Now you have to be careful with some of the emerging stocks, the emerging areas. So people talk about China. Bear in mind in China, you are not allowed to gamble unless you go to Macau. So there is an alternative called the stock market. So be rather wary. Most Chinese companies will have direct influence from the party, and so you're not dealing with standard accounting practices. It's a very strange accounting practices. I would prefer to deal with the effects of China rather than necessarily directly in China. So that is one area. The other one, of course, is Southeast Asia, which I know much better because of my family connections down there. The rise of the Oriental consumer, which is primarily my daughter, is really quite remarkable. See how Indonesia has changed in terms of the amount of retail outlets there at huge scale, and it's growing. The middle class there and in Malaysia, throughout that whole area. So that's one area certainly I'd favour for a longer term.
Yeah, absolutely. And I think in terms of investment, it's also keeping your eyes open to any potential opportunities. China is the one that's been grabbing the headlines. It may well be the largest economy in the next 10 years, as predicted. You've got a similar sort of urbanisation, ruralisation story going on in India at the moment. India, of course, traditionally has had its own corruption problems, I think it's fair to say. But if you look at the general direction of travel, both in terms of China, India, some of those larger, almost subcontinents, and where we're going to be in 10 years' time. It's just a question of identifying what an investment return might be, as opposed to consistently being what we've been doing over the last 50 years, which is to naturally have a home bias.
And also, don't have to try and necessarily pick stocks with those. There are good low-cost ETFs you can try and get, which will give you at least broad exposure to it, unless you've got individual knowledge that you have. But most people don't. And one of the problems with a lot of those markets is they are very, very illiquid. So unless you've really got good knowledge of them, they can't touch. You can buy it, then finally can't sell.
Gentlemen, that's all we've got time for. Thank you very much, Justin. Thank you very much, Richard.
Pleasure.
That's all we've got time for this evening, folks. Thank you all very much for coming. I'd like to thank all of our guests tonight. Justin again, Richard, Matthew Yates from Seven Investment Management earlier. I'd like to thank all the people who made this happen, the people from This Is Money, the guys from Core London who are filming it, and Seven Investment Management as well. And thank you all for coming, thank you for watching the Investing Show, and thank you for reading This Is Money. That's all, folks. If you would like to gather your things, there are also some bags with some small presents in there for you to say thank you for coming, and you can make your way out via the lifts back to the entrance that you came in. So good night, thank you.